You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means we are back once again, episode 2 of our doubleheader here on Education Wednesday. Yes, 2 doses of Options Bootcamp coming at you live in your ear holes. If you're one of our many pro members lurking there in the live chat, of course, if you're listening on demand, we love all you folks too. You're going to get this a week from now there. Don't blame me. Mr. Dan is traveling hither and yon these days. If you want to upgrade so you can join us live for this show, everything else we do throughout the week, great pro Q&As, options oddities every Friday, and a whole bunch more. Get your questions bumped to the top of the list, just like our buddy Mr. Donny B did last week. You know where to go, theoptionsinsider.com/pro, or indeed /secret club for all of you cool kids out there. Of course, if you are one of our on-demand people and that works for your schedule, we get it. We love you. All we ask then is that you give a nice rating so other folks can continue to discover this program that has been running for many years, and we know a lot of you love. This week's 5-star review comes from Bill Haney. He says, I guess I'm one of your newer listeners. Well, welcome, Bill. He says, I came in because of the good reviews, and now I'm doing my part to pay it forward. Thanks for the great content. Well, there you go, Bill. An excellent living, breathing example of how valuable your reviews are out there, listeners. You know, we've been doing the show for a while. We have a lot of great reviews, but you could argue that the newer ones are more important than ever because so many people are discovering these crazy options things. And that's happening still now that maybe the meme stock stuff is maybe a little bit behind us. Maybe we're looking at a little bit more topsy-turvy or downside markets. People want to learn about hedging and speculating and volatility and all the things, portfolio defense, that are very important as well. So keep rating and reviewing. It does help all those new folks discover the show. And when they discover the show, unfortunately, they also discover my compatriot here, the black-hatted one himself, Mr. Dan Passarelli from Market Taker Mentoring. Mr. P, welcome back to the show, sir. What do you have to say for Mr. Bill, one of our new listeners?
Oh, no, it's Mr. Bill. Mr. Bill, we are super glad to have you in the fold here, and I think you'll enjoy being part of the family here. We take a personal interest in our listeners because, hey, you know, you guys are the reason we're doing this. So welcome. Glad to have you.
That Mr. Bill reference just went over the heads of 90% of our millennial and Gen Z listeners, which are a ton. They're coming straight from TikTok to this show, and then you're throwing Mr. Bill at them, sir. So you just drove them right back to TikTok. As we keep on rolling right on into a little bit of your old mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody. Welcome to the Mail Call, the portion of the show where you folks take the reins, your questions, your comments, your pearls of wisdom, your subjects you want us to discuss here on the show. And Mr. Dan, this is usually where we take a break for your question of the week. You are still indeed basking in the afterglow of the great annual MTM retreat. I'm sure you had a plethora of awesome questions coming at you. What are some of the ones that resonated you want to share with our audience, sir?
Oh, man, I will tell you what. We did really have a lot of great questions. And one of them, somebody brought up to me as an aside just something about covered puts and was like, hey, am I protected if, I buy a put? Like, what if I buy a put and buy like one share of stock? And I was like, well, here, like, hold on a second. There's a couple of different things. First of all, we don't really say covered put very much. If you buy a put and then buy 100 shares, because each put represents the right to sell 100 shares, so you're protecting 100 shares, that would be called a married put or a protective put, depending on certain timing. And then I went on to say, I mean, maybe if you're looking to do something a little different, like you're talking about here, if the put has like a 45 delta and you own the put and then you're long 45 shares of the stock, you would be considered what's called delta neutral, and you would have no directional risk at that point. And the person I was talking to is just like, this little light bulb just clicked. It's like, wait a minute, that's what delta is? And of course, my answer was, well, that's one way to look at delta, and it's a really good way to look at delta. And I just kind of figured that I'd share that because looking at that definition of delta, that context of delta, ended up being really, really helpful for this person. So maybe it is for you at your level in your journey as a trader as well.
He said, I thought it was just an airline, but now I've learned so much more about Delta. So well done there on your retreat, Mr. Dan. Let's go out to some of you folks here. Let's go to, I like this handle, Brian and Stewie. I'm guessing perhaps he's just a big Family Guy fan. He says, hola, OBC. Well, hello, Brian and or Stewie. He says, I saw the headlines about a new Cboe trading floor hitting Chicago. I think you guys used to trade on the old Cboe floor. Yes, you are correct. We did. He says, what do you think about the new one? Have you seen it? And what, if anything, does this mean for the markets? Yeah, if you missed the headlines, if you're not reading the local headlines around here in Chicago, actually, this was somewhat of national news. A lot of big financial outlets carried this. You don't see a new big open outcry trading floor coming online every day. So it did make the rounds out there. But this happened at the beginning of this week, listeners. And I'll just read you a little bit from the release from the Cboe. It said, today, Cboe Global Markets celebrates the grand opening of our new trading floor located in the historic Chicago Board of Trade building. The new trading floor returns to the same space where it was founded in 1973 as the first listed U.S. options exchange. Our new and enhanced trading floor offers a vibrant, technology-driven environment that seamlessly integrates both open outcry and electronic trading mechanisms to provide customers a truly unrivaled world-class trading experience. Our customers continue to find value in open outcry trading for price discovery, deep liquidity, and execution quality. So there you go, Mr. Dan. New Cboe trading floor. They have the new offices kind of right down the street here from the studio. That's not where the trading floor is. The trading floor is back in the old Board of Trade building. Mr. or perhaps both Brian and Stewie, they want to know if you have seen it. I have not, by the way, just opened. And he wants to know, what do you think about it? And what does this mean for the markets, Mr. Dan?
Yeah, so I have not seen the new trading floor. I have been to the new headquarters, which is incredible. And so I was, after the retreat, Kathleen and I stayed with John and his wife, Amy, and we went out and did a little bit of wine tasting for a couple of days. And woke up yesterday morning after a couple of days of really solid wine tasting, and knowing that I had to sort of get on the road and pack up stuff and, prepare for a long day's travel, a friend of mine sent me that press release, and she's like, why are they going back to having a trading floor? And I looked at it and I was like, kind of rubbing the sleep out of my eyes. I was like, oh, I hadn't heard about this. And then I read the article and I was like, oh, no, yeah, I have heard of this. This has kind of been a plan in the works for a long, long time. And it's a new trading floor in the sense that, like, they just built it and it's very, very state of the art, which is incredible. But I mean, it's not a new thing. They're not going back to open outcry. They're moving pits that have been open outcry, were open outcry yesterday and last week and last month and 10 years ago, to this new facility. It's new in the sense like, hey, if I buy a new house and sell my old house, like I move to this new house. So yeah, I mean, nothing's really fundamentally changing, except that it's a very state-of-the-art room, and arguably, they'll be able to perform better, and there's lots of room to grow, and such amazing technology. So, yeah, like that's more what's going on, just so that everybody's on the same page here.
Have you seen the pictures? There's windows. It looks very much bright and airy, maybe too bright and airy. I don't recognize it as a trading floor. I'm used to the cavernous dungeon we all spent many days in, as opposed to this bright and cheerful place where you may actually want to spend time. It looks wrong to me in many levels there. I guess you're trying to attract a little bit of a different crowd there. But yes, they are moving pits that already do have existing open outcry, SPX, VIX, all that kind of good stuff. The SIBO's kind of legacy proprietary products, they are moving those along. It's not a huge change there. Scenery-wise, it is. New technology, all that good. The old floor was just too big. This is much smaller. The old floor had encompassed all the names that when Dan and I were down there used to have, not just the SPX and even the OEX back in the day, but VIX and NASDAQ, plus all the big equity options you could think of back then. That's all too much space. If you went down there recently in the last couple of years, you saw a lot of it had switched to office space, which was kind of depressing to see the old trading floor morphing into just like cubicles. So they took advantage of this to kind of shrink things down, focus on the ones that are still trading. And of course, there is still a lot of volume going up in these. In fact, your question was interesting. We kind of thought something similar when this trading floor was announced this week, because we asked you guys, this is our question of the week this week. Cboe launched a new open outcry trading floor this week. So our question of the week is a simple one. Does open outcry still have a place in the modern options market, or is it an outdated relic of the past? We gave them three choices, Dan. Yes, it's still important. No, electronic or bust, or what's open outcry? What is your vote, and what do you think our audience is voting for?
I mean, my vote for sure is that it certainly still has its place. That's where a lot of the institutional trading gets done, because it's legit more efficient that way. Boy, it's tough to say what our audience would say. Geez, I think I might assume that they think it's antiquated, but it's a tough call. I'm not going to be surprised either way.
Right now, we got some savvy folks. Yes, it's still important. 51.5%, sir. And then
great.
No, electronic or bust, exactly a third, 33.3%. And then what's open outcry, 15.2%. So that gets back to maybe some of our millennial and Gen Z folks earlier who are still scratching their heads over that Mr. Bill reference you made earlier in the show. Mr. Dan, get over there at options. It should be, if it's not pinned, it'll be floating around on our timeline. Just scroll down. You'll find it. We'll retweet it throughout the week as well, so you guys can participate. We'll give you the final results on that, just like we did for our last episode. We had a big question of the week. A lot of you guys were curious about, so we'll pay that one off for you now as well. We asked you last episode, the volatility of volatility itself, aka VVIX, is back below 100 for the first time in over a year. Is this the start of a new vol regime for the market, or just the calm before the next volatility storm? Gave you three choices on that one as well. The start of a new volatility regime, the calm before the storm, or vol is confusing, similar to our choices for this week. And 75.8% of you said it's the calm before the storm. 14.5% say it's the start of a new vol regime. And 9.7% of you find vol confusing. I understand. It's a confusing concept, especially for the audience for this program. Dan, does that surprise you? Almost 80% of our listeners think this is just the calm before the storm, sir?
No, it doesn't surprise me. I mean, we're reading a lot in the news, and there's a lot of folks who are looking for a lot more room to the downside. Of course, you get your evergreen bulls too. So it's hard to say, and I don't put a lot of stock in what people say in the news or what reporters say or anything like that. But yeah, so I guess I'm not terribly surprised by that.
All right. Maybe you'll be surprised by this one. This question comes in from Tim. This is right up your alley, Dan. He wants to know, quite simply, are short squeezes dead? And is there such a thing as a downside squeeze? Well, I can imagine, Dan, you have a lot to say about the first part of this question because you're out there rating, and that's all about the short squeezing. So you could fill in Tim on that. For the second part of his question, is such a thing as a downside squeeze? Yeah, it's called a crash. That's when the names just sell off aggressively. It's not so much squeezing as being just jammed down aggressively with a bunch of aggressive sell. Everyone's trying to get the heck out of Dodge, right? They're hitting bids. So that's a crash. I wouldn't really call that a downside squeeze. You may view it somewhat in a similar fashion, but they are very different beasts at the end of the day. I like that. I'm going to start calling them downside squeezes from now on. Dan, what do you think about short squeezes? Are they dead? And what are your thoughts on downside squeezes?
Yeah, so as far as short squeezes being dead, I spent a lot of time thinking about that because they did kind of slow down a little bit with all the volatility. But what has become interesting is that because there are some folks who are worried about going into recession, like some of the same things that people looked at an acceleration of GameStop going bankrupt and AMC going bankrupt are kind of back into play. Not in AMC's case, not the pandemic, although, that is still in it almost as full force as ever, which a lot of people tend to forget. And, GME just still having that brick and mortar presence, which is antiquated. But both of those things are going to get aggravated if we go into a recession. Not a lot of people are comfortable going to the movies right now. Although I did just see a couple weeks ago the new Nicolas Cage movie, which was really fantastic.
I thought you were going to say the Maverick one, because everyone's just gushing over the Maverick thing. But people like the Nick Cage one, too. I kind of want to see both of them.
Yeah, I kind of want to see the Maverick one, too. But, this, I went and the movie theater was pretty empty. And so Ty getting put out of work on that, and it's likely to be more empty, and same thing with GME. And so the moral to the story is, if you look at the short interest on both of those stocks right now, they're higher than ever. And so it is the high short interest that drives short squeezes because people get forced to cover. And if you're short just a crap ton of stock, you have to buy back a crap ton of stock. So short squeezes are definitely, who is it that said the rumor of my death is greatly exaggerated? Same for short squeezes. They're not just still alive and kicking, but they're going to be more important, I think, over the next couple of months.
Ooh, more important. Interesting. Yeah. If you have thoughts about the overall questions about the overall economy and levels, how things like rates affect it and everything else like that, where you should be buying in the S&P. We had a great pro Q&A with John Brady from RGO. He had some interesting, very controversial, perhaps, things to say about buy-in levels on the S&P, the impact of rates and inflation in the Fed, and commodities, nat gas, wheat, you name it. We've got into a lot of subjects. So check that out, theoptioninsider.com/pro. If you missed it, listen, let's go out to Macaulay. She has a question, but it's kind of more of a comment, I think. She's saying, or perhaps he, could be the last name, why is it so ridiculously complicated to figure out how much margin it costs to sell a freaking put? Exclamation point. Thanks for setting us straight. Well, you're welcome, Macaulay. I think is referring to what we talked about on a recent episode where we walked through this. And you're right. It is not really readily apparent to the lion's share of people who see this exactly how much how much capital they have to put aside for this trade. And I love the brokers. They put this out there, this kind of 3-part thing, thinking they're doing their due diligence and making it really clear and really straightforward for the end user, when in reality, it's anything but. This is kind of the example we went through. Most of the brokers have something similar. It's going to vary depending on your broker and your account size and your margin type and all these kinds of things, and your relationship with your broker. Even if you call them up and they like you, maybe they'll do a little bit more work for you there. But in general, these are the basic outlines that most of the brokers are going to throw at you out there. They say the margin requirement for an uncovered put is the greatest, all in caps, of the following calculations times the number of contracts times the multiplier, in parentheses, usually on 100. So that's already a very poorly written sentence. Run on, terrible. If you were in 5th grade, you get marked down for that. All right, so now we get on to the 3 choices. It's 20% of the underlying price minus, in italics, the parentheses out of the money amount plus, italics, the option premium. So that's very straightforward. Or 10% of the strike price plus the option premium, or $2.50. I think people can grasp that last one pretty easily. But the rest of them, it's written confusingly. It's not very straightforward. You have to do 3 different calculations to try to determine what your amount is. I'm with you there. Who was that? Macaulay. It is not immediately intuitive. And the example we gave for our example back a couple of shows ago, that exact calculation would have been 11 grand for one put, 10 grand for the other, or 2,500 for the third. So obviously the highest one we're going to go with, which is 11 grand. But that's a pain for people, especially if you're putting a lot of trades on, you want to do it quickly. Hopefully your broker will try to make this a little bit more readily available. Maybe we'll have a margin calculator for you right there. So if you put the trade in, it'll show you how much you have to put aside. Better ones will try to make this a little bit more transparent for you, a little bit less painful. But you're right. In general, the voodoo that goes into calculating that options buying power is a huge pain point for a lot of people. And unfortunately, it only grows as you get more sophisticated and try to put on more advanced types of trades. You're going to bump into that time and again. Mr. Dan, any thoughts here on, as Macaulay says, why it's so ridiculously complicated to figure out how much margin it costs to sell a freaking put?
Yeah, and you know what they left out of that as well is then if the stock gets a whole bunch more volatile and people start selling a ton of puts, they're just going to take all those words they just said and throw them out the window and make up new rules on the fly. There's that.
Yes, witness GameStop and AMC and all that madness when they change the rules for calls, right?
Yeah. So, yeah, I mean, it would be nice if there was just sort of set universal rules, but I mean, hey, every company can make decisions for their own risk management teams, and yeah, you know, I guess the thing is just realize that you're going to get margined a fair amount. And that's why for me, 90% of the time, the only time I'm selling puts is in a cash secured scenario where I've got way more cash set aside than what the margin requirement would be, because I'm preparing to buy the stock.
There you go. Let's go out to a few more here. We were off live for a couple of weeks here, so we have a couple other questions of the week that we asked you that you guys were voting in fast and furious. You want to pay off for you. First off, from a couple episodes ago, a lot of people weighed in on this one. We asked you about your buy-in levels the week before in the S, and a lot of you also said you were waiting for a bit of a vol spike to go along with that sell-off before you really felt comfortable buying in. So we asked you, do you believe in that? Do you think VIX really needs to spike to signal concession in the broad markets? And if so, what level does VIX have to hit? And it came out with 42.8% of you saying just north of 40. That's enough for you. So not a crazy spike, but north of 40, 24.1% saying north of 50, 21.7% still holding out. It's nearly a quarter of you saying you need that north of 70 spike. You really need a serious pop in VIX before you're comfortable buying in these markets, and 11.4% saying north of 60. Dan, does that surprise you? And also, are you a believer in that theory that we need a big vol pop in order to really signal concession in the broad market?
Well, yeah. I mean, in order to signal concession in the broad market, or what's the word I'm looking for? Capitulation.
Capitulation, yes.
Yeah. Then, yeah, like that, I feel like by definition, you're going to need that big vol pop. But that doesn't mean that the market can't turn around and head higher and drift somewhat higher too. It's just two different scenarios of what, I mean, ultimately is going to be inevitable. I mean, the market's not going to stay at this level for the next 10 years. It will end up trading higher at some point, and who knows? I mean, if we go into a deep recession or stagflation, I mean, it could be down here for a couple of years. But I mean, it will head higher. So it's just we're musing more about what that might look like than will that happen. And the two main categories are just that. You just get really just like everybody's stomach just turns so much that they finally just give up at the end and sell out and capitulate. And, I'm out. I can't handle it anymore. And that's when like the last person sells out and then it goes back up, which is unfortunate for those people who just sold out. Or, it ends up sort of drifting higher and earnings and valuations catch up with one another. And we're sort of back to what is generally perceived to be normalcy in the market. Those are the two main, broadly expected ways of a turnaround to happen. But, it could happen other ways as well.
All right. We've got this question here from DC. Looks like this is a better question for Vol Views. I think we'll save that one for there. We'll get us out of here on this one here from Neil. Neil wants to know, how do things look on the, quote, party front? Is it continuing through the middle of the year? Well, by party, Neil, I'm assuming you mean the options volume party, and maybe not Dan's big shindig that he just held out there in Sonoma a few weeks ago. But yeah, let's go here really quickly. And let's see. We'll pull up the numbers. Just came in last week for May from our friends over there at OCC. And the short answer, Neil, is yes, the party is continuing. OCC announcing ADV through the end of May was 41.7 million contracts. That is up 6%. So year-to-date average daily volumes up 6%. So that means if we stay on this track for the rest of the year, we're going to beat last year's numbers by about 6%. So that's certainly nothing to sneeze at. Last year was a ridiculous level, almost 10 billion contracts. And May volume up 19.7% from May of 2021. Remember, May of 2021, no slouch. We were still kind of in meme, I guess you can call it meme 2.0 by that point, or just starting that. But there was a lot of paper going up. Everyone was buying calls this time a year ago. So the fact that this May surpassed it by nearly 20%, nothing to sneeze at. A few highlights here. ETF options volume up 64.1% in May. Index options volume up 49.4%. Some big highlights there. So yes, Neil, short answer to your question, the party is still alive through the middle of 2022. All right, Mr. Dan, that music means we've come to the end of part 2 of our doubleheader journey for this week. But before we go, if you have any thoughts from Mr. Neil on the ongoing saga that is options volume, have at it. And then if folks want to reach out to you, do some market mentoring, where should they go? What should they do?
Yeah, as far as volume goes, I expect that just going forward, I mean, it's an industry that is in an uptrend, though all uptrends have peaks and troughs to them. And for some reason, people trade more options when the market's higher. It almost doesn't make sense to me. But, we see that just empirically happen. So, I mean, I wouldn't be surprised if volume pulls back a little bit in the short term. I mean, could even be the rest of this year, but there's just more and more interest in options because we can use them to protect ourselves. We can use them to speculate, and they're just really, really useful tools that sort of level the playing field between, regular Joes and institutional pros. And as far as reaching me, you can make your way over to markettaker.com. Market is in stock market, takers and take what's rightfully yours, 2 G's in a row, markettaker.com. And, you could join free. If you listen to our last episode, We do have, it's kind of a quasi invite only, if you weren't invited just yet, and you're an experienced trader, and frankly, you have something to contribute to this mastermind that we're going to be holding here in the late summer and early fall. You should please go to my website and hit contact us and ask about it. It's not really for newer traders. It's a very, very small group where we all trade together live in person. I'm going to ask Mark if he'll swing by. It's going to be held at the brand new Chicago Board Options Exchange headquarters, not the trading floor we talked about.
They won't let me in that place, sir. That's like a crucifix on the wall. The vampire walks in, I launch on fire. No, that's actually right down the street, so that should be pretty close.
Yeah. I can sneak in my suitcase too if it's a thing. So yeah, we'd love to talk to you if it's a good fit for both of us. If you're pretty experienced and you've got some great things to share and you really want that live experience and make some really important connections to other really great traders too, it might be for you. And feel free to contact me through our website, and we'll talk. I'd be glad to personally give you a ring on the phone.
There you go. MarketTaker2Ts.com is the place to go to learn more. And of course, you know where to go to learn more about all things pro. You want to join us live? We got Mr. Brian coming up a little bit later today for OPR. He's back from his travel schedule as well. No guarantees on the live for Brian. Sometimes he doesn't like to do the live too often. He likes to be live to tape. If I can force him into a huddle, then maybe he will go live. So we shall see. Maybe we'll be back with Brian later today on the live front. Of course, it'll be live on demand on the network. So wait for that one to hit up. Some good stuff there on OPR. If you're listening to Boot Camp, not listening to OPR, very much sister shows. A lot of education going on between those two. So check out OPR if you haven't done so already. Then back again, of course, tomorrow, episode 2 of the Option Block, as well as TWIFO, This Week in Futures Options. I do believe the once in future and now present Dr. Bix will be joining me to talk about a whole bunch of commodity vols. So that should be fun. Friday, volatility views, break down the mad week of volatility. And then, of course, for all you cool kids in the secret club, back again after that for Options Oddities. Then we kick it all off again next week. Dan will be traveling next week, so you won't be seeing us live. You'll be seeing us live to tape on the network. All you cool kids already got it live in your ear holes right now, so you don't have to wait a week for that. And then we'll see you back the week after that, another episode of Options Boot Camp.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.